Hi guys, welcome back to the channel. My name is Dave, and it certainly was an interesting week in the stock market. Overall, not too bad. If you just buy the S&P 500, we were up about 0.5%. But with the release of DeepSeek over the weekend, #1 app on the App Store, we saw Nvidia decline 17% on Monday, or lose about $600 billion of its market cap. Just the threat of less expensive AI was enough to cause this expensive stock to decline by 17%. Ouch. Then on Friday, we saw Donald J. Trump move forward with his tariffs on China, Mexico, and our neighbors to the north, Canada.
No way, eh? Take off, you hoser!
So I guess after this, I'll head to Costco. I'm going to fill up with a 55-gallon drum of maple syrup. And I don't know, it feels like I picked the wrong week to stop sniffing glue. So anyway, back in 2024, I made the conscious decision to start investing a little bit more of my money outside the United States. I still predominantly invest here in the US, but I think it's important to diversify for myself and invest a little bit more outside the US, especially with all the changes that we have happening. Who knows how this is going to shake out? I'm not sure, so I want to diversify away some risk. So today I'm going to share some of the ETFs that I've been buying that are non-US ETFs. If that is what you're looking for, please stick around. Whoop. So before we jump into this, just to be clear, there's been one place to invest in the whole wide world over the last decade, and that's right here in the United States. It's outperformed everything, correct me if I'm wrong, but this is where I've been investing. I've been fortunate to do that, but I'm getting to that point now where I want to diversify away some of my risk. Now, going back over the last decade, I haven't found a good combination where you buy the S&P 500 and you add in an international ETF and it makes it better. But that could change going forward. So I'm looking at 5 to 10% exposure with these ETFs overall in my portfolio. And I'm hoping that's what it offers going forward with all the changes that we have going on here in the United States. We'll see how it pans out. In some ways, I compare it to buying Bitcoin, which I have a small percentage of in my portfolio, and I believe it diversifies away some risk, even though I'm not completely orange-pilled with the idea, but I think it can help me diversify a little bit. So anyway, with that idea, let's jump in and take a look at some of these ETFs. So let's start with VYMI from Vanguard. This is their International High Dividend Yield Index Fund ETF. If you're familiar with VYM by itself, I've been buying that for many years. It's performed very well. So that's one based on US stocks. But add the I, we get the international flavor in this particular case. And it's a pretty approachable, good way to start if you want a lot of exposure, but you still want some income. So I know I got income investors on this channel along with growth investors. This should offer a little bit of both. Expense ratio is reasonable at 0.22%, which isn't bad for an international ETF like this that has over 1,500 different stocks inside of it. It yields 4.68%, so not too bad, right? I know it's not glamorous like some of them if you're an income investor, but it does offer you a nice little quarterly distribution. Now, VYMI seeks to track the performance of the FTSE All-World ex-US High Dividend Yield Index. It's got the largest concentration in Japan, the United Kingdom, and Canada. It's been around since 2016. It's just an efficient way to gain broad exposure to non-US markets. Top holdings are in things like Toyota and Nestle. And it contains over 1,500 stocks, as I mentioned. So reasonable, good way to get started. If you have no exposure yet, check out VYMI from Vanguard. Next up, we have SCHY from Schwab. This is the International Dividend Equity ETF. So for fans out there of SCHD, how about SCHY? Currently yields 4.5% and invests in non-US high dividend yielding stocks that have a record of paying dividends for at least 10 consecutive years. Sound familiar? Just like SCHD. And like SCHD, they also screen for stocks based upon market cap, trading volume, free cash flow to debt, return on equity, forward yield, and 5-year dividend growth. So all this boils down to 134 chosen holdings that are reweighted every quarter to ensure that they don't exceed 4%. So International SCHD pays a quarterly dividend. Expense ratio is quite reasonable, 0.14%. Again, yields 4.5%. So if you're an income investor, it's not too bad, right? It's a lot of diversity, gives you a little bit of income. Perfect. Next up is IDVO from Amplify. This is one that I started buying when it first came to market. Again, this is the same group that brought us DIVO, so this one will involve options. It's their International Enhanced Dividend Income ETF, but a good little fun. A little bit more expensive on the expense ratio, 0.66%, so you have to decide if that's right for you. It does pay you every single month, so if you're looking for some monthly distributions, this could be a good option for you. But this one seeks to provide income from international dividend-paying stocks and by opportunistically writing covered calls on those stocks. So currently has 86 positions, and they're all ADRs, American Depository Receipts. Again, you can watch that other video, go into a little bit more depth about that. It's yielding 5.92%. And just like the rest of the funds from Amplify, they use a tactical covered call strategy. So they're not doing it against every ADR that is in the portfolio. They're hand-picking those, deciding on a monthly basis on what they're going to sell those calls against. But it's a nicely diversified product. It diversifies across lots of countries and lots of sectors. So good one that I continue to build upon in my little income portfolio that I have. Again, you've got that expense ratio. You can see the one-year performance up about 8%. Add in that about 6% yield. Not too bad for 2024 for being something that's investing outside the United States. And again, I think it's got a lot of promise going forward. So check out IDVO and that review as well. Also, all of the information that you see here comes from Seeking Alpha. I am a Seeking Alpha affiliate, and there are affiliate links down below for discounts. So one of the things that I love about Seeking Alpha and that I often point to is for products like IDVO, you're often going to find not only the information that you need to get started, but also analysis from authors that do this for a living. They're going to go and do a deeper dive and give their explanation of why they like this particular product. So I get a lot of benefit from reading these articles. So again, if you're looking for a stock and ETF research tool, check that out down below. Next up, VWO. This is the Vanguard FTSE Emerging Markets Index Fund ETF shares. So now we're talking about emerging markets, and this invests in stocks of companies located in emerging markets from around the world, such as China, Brazil, Taiwan, and South Africa. Top holdings are TSM, Taiwan Semiconductor, Tencent, and Alibaba. Alibaba and I have a love-hate relationship. I do own some shares. That's one of the only ones in here that I actually own individual shares of. I was in it. It crashed. I got out. It crashed. I got back in. That's where I sit right now. We'll see how that plays out, but it's one of the few individual stocks that I have that's outside the United States. But VWO contains over 4,900 different stocks. The vast majority of these stocks are from emerging markets, with the top three being China, India, and Taiwan. And those three countries comprise about 73% of the fund. So you have to decide if that's a place that you want to invest in. Yes, if you follow along here, I'm losing my voice. I'm working through it, though. Anyway, expense ratio on this one, 0.08%. So quite reasonable as far as the expense ratio goes. It does pay a little bit of a yield, 3.17%. And across 4,900 different stocks, I know that's a lot, but you do have that concentration in those three countries. But if you're looking for emerging market or an emerging market ETF, check out VWO from Vanguard. Next up is FXI, the iShares China Large Cap ETF. So let's talk China, our friends to the east or west. How would a flat earther actually get to China? Do they have a choice? I have a choice. I'm not sure about a flat earther. But anyway, the iShares China Large Cap ETF seeks to track the investment results of an index composed of large cap Chinese equities that trade on the Hong Kong Stock Exchange. So this ETF focuses on the 50 largest stocks in China. So think things like Tencent and Alibaba, but also the Bank of China. So I've owned this particular ETF for a while. I typically sell calls against about 3/4 of my position and let the rest ride. But China's seen their economy really slow down. It seems like it's just waiting for more stimulus. This is when everybody right here thought, oh, we're going to get a bunch of stimulus, and it took off. So we're waiting for that spring to sprung or something like that. So anyway, I have this in my portfolio, and we're going to see when China decides to go from trough to expansion. And the answer there is it's when China decides to. That's the answer. So we'll see. But FXI offers some opportunity if that ever happens. So the expense ratio, it is pretty expensive, 0.74%. Does pay out a little bit of a yield. But really, in this case, you're betting on China coming around and deciding to stimulate that economy. And if it does, stocks like Alibaba could really take off, which again, I own a little bit of Alibaba myself. So hashtag pray for Alibaba. No, that's not true. So we'll see what happens there. So now let's take a quick look at performance of those 5 stocks versus the S&P 500 over the last 3 years. Now, one of them, IDVO, has not been around that long. So it missed out on a tough early part of 2022. So let's take that into account as well. But you're going to see these international ETFs have not kept up with the U.S. market. So if we look at FXI, your bet on China 3 years ago, you would be down about 9%. Again, this is total return. So all those distributions factored back in. VWO, total return, down about 0.5%. So still, you're losing money if you invested 3 years ago. IDVO, pretty impressive, up 43%. But again, take into account that it did miss part of 2022, which was a negative for pretty much everything. But still pretty impressive since inception. SCHY gave you a little bit back. VYMI, best of those 5, up about 18% total return. But again, compared to VOO, or just buying the U.S. stock market, large cap, up 40%. So hard to keep up with VOO over the last 3 years. So my question to you is, do you invest into these now going forward, knowing that there's been underperformance going back many years compared to the U.S. stock market? Is it time to start investing that way? And since we're talking about the whole world, let's do a little bit of a speed round for some other products that you could consider, starting with VGK. So if you're looking for exposure to Europe, check out this one from Vanguard. Again, a very reasonable expense ratio, and will give you exposure to those European stocks. Then there's things like CNYA. So we talked about FXI, but this will give you broader based exposure to China with about 425 different stocks. So that might be an option for you. How about IGRO? This is the iShares International Dividend Growth ETF. So if you like that SCHY, which was like our SCHD, but for international, this is like DGRO, but it's IGRO. So again, another approach to it, offering about 2.37%, looking for dividend growth internationally. Then we can go to JPIN. This is one that I've had in my portfolio for a while, and it's actually done pretty well. You can see there was a drop off here, but offering over a 4% yield. JPIN, pretty broad-based international exposure, one that I own some shares in. And then if you want the whole kit and caboodle in one purchase, then you can look at VXUS, the Vanguard Total International Stock Index Fund ETF shares. So I have this in one of my M1 accounts as a simple way to invest internationally and add a little bit of that exposure. Again, yielding 3.2% and a very reasonable expense ratio. So great way to get exposure. One click, one buy, and you've got it all. So there's your speed round. What is that? Another 5 that you can look to if you're looking to diversify away a little bit from the U.S. So I'm curious about your approach right now. What do you think? Is it time to sit on the sidelines and buy some short-term treasuries with some of your cash? Or would you take that and pile into U.S. stocks? Or would you diversify away and try to buy some international ETFs? How would you put money to work right now? Let me know your game plan down below. I'm curious. And if you like this type of content, like and subscribe. And I will work on my voice. Hopefully I get it back fully by next week. We will see you then. Have a great night. Take care. Whoop.